Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. We've been doing this for 5 years, getting together, having live conversations with industry experts. And tonight is going to be like no other. We've got Nathan Webb here tonight to talk about 1031 exchanges. What is necessary? What do we need to know? It might not be your 1031. It might be a client, an investor. They may be coming to you and saying, hey, I'm selling this property. How do I get into a syndication? So I would love for you guys to be able to walk away tonight and know how to help this investor or yourself. So if you have a deal you're looking at and you're trying to figure out where is the debt, because the lender is your biggest partner, I can help with that. That's what we do. We are specialists at Old Capital Lending. We've closed over 7,000 loans in the 38 years that we've been in business, $1.2 billion a year. So there's only 8 of us, and we're here to help you, get you educated and provide your debt. So let me take a look at it before you put in an LOI, because you'd hate to overpay. Putting in an LOI without checking in with the lender could be really risky. So don't do it. Come get a hold of me. I'm going to need your T12, your rent roll, your offering memorandum, if there is one, and your underwriting. And we'll take 48 hours to get you the information of how much I can bring, right? How much you're going to need to capital raise. And as you know, capital raising is challenging in this market. So the time is now to come to Zoom at 8 to find your partners. This is where you can find investors, sponsors, lenders, cost segregation. All of your partners can be found here. As I say every week, this is like going to a conference, but you don't have to buy your ticket. You don't have to pay for a room or a rental car, right? Or the hotel. That costs thousands of dollars. It's free here at Zoom at 8. So take advantage of the people in the room. All right. Well, we are ready to roll out into our live conversation. So tonight, I'm excited to introduce you to Nathan Webb. Nathan has been here. I have used him in the past. That doesn't sound very nice, does it? I've used him. We have done business together on several deals, actually, on a 1031. And by the way, if you're not doing a 1031, that's okay. This may be something that you need to understand for your investors, because wouldn't it be great to find an investor that has $1 million that they're looking to place, and maybe you're looking for $1 million guy to put into your deal? You got to have the resources to help them. And that's why I'm bringing Nathan Webb tonight. Nathan has spent over 12 years in real estate and business management, including oil and gas upstream production, project and property management, multifamily, industrial and retail acquisitions and analysis. He has spent the last 6 years specializing in 1031 exchanges and advising on them regularly for both large and small capital groups, private investment banks, and individual investors, ensuring tax code compliance, and qualified exchange investments nationwide. So I want you guys all to get out your pencils and start to kind of figure out how you can engage and learn about 1031s how an accommodator can help you in this transaction. So welcome to Zoom at 8. Nathan Webb, thanks so much for joining me. Welcome to Zoom at 8. Good evening. How are you?
I'm doing great, Julie. Thank you so much for having me. As Julie said, we've known each other for a while. I used to live in California, not too far away. Our headquarters is based in California. I live in Atlanta now, but still handling exchanges from coast to coast. Doesn't matter what state, all 50 states qualify. It defers. It's federal tax code, right? So it's across the nation. Even works outside of the country, as long as you stay outside the country, for U.S. taxpayers. So it's a pretty diverse section of the tax code. And I've also been involved in real estate for a long time, both inside the United States and outside. So it was kind of an interesting niche that I found myself in. But Julie's great. As you guys all know, she's fantastic at what she does. She's a fantastic networker. You guys have found the right person to hang out with and learn from, because she is excellent. And she helps you direct business, all kinds of things. She just brings people to you. So always appreciate, happy to be a part of whatever Julie has going on. Thanks for
Oh, thank you so much. I'll send you the Venmo. I told you I'd get you paid off on that. Listen, I think one of the struggles that we have in this industry is understanding how to help people with the 1031 exchanges and the whole process. It's very cumbersome if you're not aware of how to structure the deal. It's a tenant in common. Can I do tenant in common from a single family into a syndication? So I'm hoping that we can unpack that today, Nathan, so that everybody in the room has a clear understanding. And again, this is a live conversation. You're in the room, everybody. So Nathan is going to make himself available to answer your questions. Ask them. Don't be afraid, because again, it might not be your 1031. It's kind of like the solo 401k or IRA, your self-directed IRA. It might not be something that you're involved with, but when you're trying to find capital, you are a resource, you are a conduit to the people that will help you. And that's why you need to know Nathan and his team to help you execute and get your investors' money on board. So, Nathan, how should we start? Are you going to provide us with a
I have a whole presentation made for you that is like
awesome,
just a wealth of information that you guys can request later. I didn't make it pretty. I like to make it pretty and entertaining, but I know that you guys you're very good at drinking water from a fire hose. So I just prepared a presentation that threw a lot at you that you can digest and come back with questions later too, if you need to. And I'm happy to share that presentation with you. If you want me to go through it, I'm ready.
we're ready. This is going to be excellent.
Great.
So go
Can I
for it.
share
Yep,
screen?
you are good to go.
I can. I'm good to go. This is awesome.
Yes. Everybody put your view on speaker if you'd be so kind, and give all your attention to Nathan Webb at American Accommodators.
Cool. You guys see 1031 exchanges with partners, correct?
Yes, sir.
Excellent. So this presentation has to do like, is it really partnerships with 1031 exchanges? There's some nuances, right? But this is solely speaking about 1031 exchanges with partners. Julie already went over my background, but I've got a variety of experience across asset classes that all ended up qualifying for 1031 exchanges, including oil and gas, multifamily, net lease properties, retail, industrial, even fractional interests, as we're going to discuss as well. And so had a pretty interesting background in that, but I have to give everyone the disclaimer, right? This is for education, maybe a little bit of entertainment purposes, because as an accommodator, I often work with attorneys, CPAs, financial advisors, all of those things. And that's not what an accommodator does, but the tax code has to do with real estate. It has to do with taxes. It has to do with legal. It has to do with finance. There's a lot of things that go into it. And my knowledge and education and what I'm sharing with you is very specific to the 1031 exchange, which touches on all those areas. But please don't take it as personal tax or financial advice. Just know that, hey, we're going to be touching on a lot of things here. No guarantees, right? No guarantees. Talk to your licensed experts for that, right? Before we get into the partnership thing with 1031 exchanges and how they can be used, we got to understand the fundamentals. So I'm going to go through this quick. Some of this may just be a refresher course for you. Some of you may not realize some of these things, but let's talk about the fundamentals at first. It is a real property to real property value transfer that defers capital gains taxes, depreciation recapture, net income investment tax that is typically due on the sale of an investment property if there's been depreciation, if there's been capital gains. The exchange process is tied directly to the taxpayer, whether that is an LLC, taxpaying entity, or an individual. And so Real property to real property is important to keep in mind, as well as taxpayer. I'm going to be covering those multiple times, but that is in essence what it is. It's a rollover tied to a taxpayer tied real property to real property. Okay. But what is real property? It includes anything pretty much that you can hold title to, right? That does include condos, single family, something that you've been using for an Airbnb. Yes, it includes multifamily, all these different asset classes, including wireless easements. Like if you're into cell towers, those qualify as well, and all the different fractional interests therein, right? And it doesn't mean that if I sold multifamily, I need to buy multifamily. We hear like kind exchange a lot. That like kind refers to real property for real property. Or it used to refer to business property for business property, like inventory. That doesn't exist anymore. We're only dealing with real property, but you can kind of jump between asset classes as you wish. It is not, hey, you're in single family, you got to stay there. You can jump across into other asset classes with the 1031 exchange, right? Oh, double there. So what does the process actually entail? It is essentially an escrow process between escrows. Between transactions, you've got the 1031 transaction. That's why the QI needs to be in place. They're essentially your money holder and your reporter, that they will send all of those documents back to your CPA for filing. You have to follow the rules with us. Well, we have to follow the rules, and therefore you're following the rules with us that the IRS has outlined. If you want full tax deferral, you need to use all of your proceeds that you exchange from your property, and you need to be purchasing property of equal or greater value in order to get that full tax deferral. That does include debt. So, if you relinquish debt, usually you're going to be replacing it with debt, but the real tax code just says value for value. So you could, inject some of your own cash if you wanted to buy something without debt. Sorry, Julie, that's not a personal attack on you, but it is, just know that it is a value equation, not necessarily a debt plus net proceeds equation for tax deferral, right? This process can fail, just meaning, well, you're going to owe the taxes that you owed anyway. And it can also be partial. So maybe you've deferred the majority of your gains that you would have owed. So it's not a pass or fail. It can be partial. And so just realize it's not something you necessarily get punished for failing either. It's just, well, you owe the taxes you owed anyway, right? I think a lot of people have probably heard about the timeline. You got 45 days to identify, 180 days to close. Remember, that's not 180 days after 45. That's 180 in total from when you sold the property. And so that's what your total timeline is. So 135 days after you identify. Identification is important, but we'll cover that a little bit more as it comes to more specifically partnering or doing tenants in common deals, right? And so there are some rules associated with that, but it's really just designation or identification is a document you submit to the QI that goes onto your report that could be pulled up if you're audited and the IRS wants it. Hey, well, we're going to have to show them what you designated. But you don't need to identify a bunch of properties on day 15 and day 30 and day 44. You can be hunting, be looking at a lot of different properties. By day 45, though, you need to be telling us, hey, I want to get the full timeline to close on this property. These are the properties I'm going forward with. That is what the designation is. It's basically kind of like a letter of intent that you're kind of saying, hey, I'm going forward with these properties, and that ties us to you and your exchange and those properties that you're looking to go forward on. So we can only send funds to what you identify. So it is an important date.
So I just want to make sure that everybody knows what a QI is, because that a lot of people, if you haven't heard about 1031s, now you know what a 1031 is. What's a QI?
Qualified intermediary.
So
Sometimes
what does
we're
that
called
mean?
an accommodator. That's why we're American Accommodators. Sometimes we're called a facilitator, but qualified intermediary.
Okay.
So we will
Keep
be
going.
out. Yeah, sorry. QI
No,
is
that's good.
short and sweet, but that's exactly what it means. It's the middleman, which is what we are, right? Most people, when it comes to identification, there are some rules. If you're a sponsor, you need to know about these rules for your client's sake. If you're going to be doing a 1031, they're also good to know as well. Most people only go with the 3-property rule, which says I can identify 3 separate properties, any value, right? And I can close on any number of them. That's usually your best bet, gives you the most options. The 295% rules are really just there because I was like, well, you can't identify the entire continental United States as replacement property and close on any number of them. So they limit you. If you're identifying more than 3 properties, you can do 4, you can do 8, you can do 20. Just realize that if the total value of those properties is twice as much or 200% more than you relinquish, so if I relinquish property for $1 million in value, I need to be only identifying property $2 million or less, and then I can close on any number of them. If I identify more than that, then my default is the 95% rule, which says I need to purchase 95% of what I identified in terms of value, right? So that's pretty much everything that you identify. So you're really kind of pigeonholed there, which is again why people go back to the 3 property rule, because it's only 3 options, but there's no restrictions, right? Any property, any percentage amount that you want to identify, those are possible with the 3 property rule. Okay. So just realize you're going to be facing those rules on the 45-day timeline if you're dealing with any clients. So if you've got a deal and they're saying, hey, I need to identify, you may need to have an answer for them, right? Because you may need 60 more days to close. They've got that time to extend, but they need to know what they're going forward into. So being able to provide them with a proper designation option is going to be key for you as a sponsor, right? I already kind of talked about the negative consequences of failing a 1031. You're just going to end up paying your taxes if you completely fail, which is fine. But they're also, hey, maybe you did fail, or you didn't choose to engage in a 1031 for one reason or another. Cost segregation is essentially a backup option. You can write off some of your gains that you may have seen on a property if you go into a deal. One of your syndications could be one of those deals where you offer cost segregation in order to write off some passive losses against gains that some clients may have had coming into your deal. So it's not necessarily that you need to do a 1031 and cost segregation, right? Because if they're deferring some previous depreciation recapture or gains, right, they're probably not going to have as much of a benefit from cost segregation, but it is there as a backup option for someone who doesn't 1031 into your deal. Opportunity zones offer some partial deferral for a couple years or deferral for a couple years, and then if any appreciation seen off of those deals in a 10-year investment hold, then it's kind of forgiven. So just know that those are kind of like parachute options. Those get a little fancy, but just know that, hey, I didn't do a 1031. You're not screwed. There are options, right?
All right, let's back up a little bit. Yep. Opportunity zone. For people that don't know what opportunity zone is, could you unpack that?
I will do the best I can. I'm not a specialist in opportunity zones, but essentially, if you invest your capital gains into an opportunity zone or opportunity zone fund, it only needs to be the capital gains invested. And then the ruling is that the gains will be deferred, not forgiven, but deferred until the end of 2026, I believe. And then they'll be owed. So it's only a short-term deferral. But typically those deals are offering a capital event. If you're running one of those deals that says, hey, I know people are getting deferral until 2026, and then we'll refi, we'll do something to get capital back to those opportunity zone investors so that they can, pay those capital gains that they owed, and then keep them in the deal for 10 years. And any appreciation seen in 10 years is essentially forgiven. So, you could, whatever.
Tax-free, guys, tax-free.
It's tax-free. Exactly. So that's what little I know. I'm not an expert in that, but I get people who are curious about that or looking for parachute options. So I'm just like, this is what I know.
Okay, so let's just give an example here. I own, and by the way, everybody, I have done 7 1031 exchanges. I've gone from single family to duplex within the residential. I've gone from multifamily, my own multifamily, 5 or more, into another multifamily. And then I've also done tenants in common into a syndication. So there's a lot of different ways to structure these. As Nathan said, you can use it all different, industrial to residential, all those different options. But essentially, you're going to put you're really going to structure this early before you sell your property, right? So if I know I'm going to be selling my property, we want to look for assets that you're going to go into. So that's where Nathan says we're looking to identify some assets. Now, for me personally, I would set up about 4 months because I knew my property would probably sell in 4 months. I was calling syndicators and saying, hey, I've got $1 million that I need to place. What do you have on the books? What are you anticipating going to be selling or buying within the next 4 months that I can get into? Okay, because we need to identify that within the 45 days. Okay, that money, when I close it, goes over to Nathan. He holds it as a intermediary. He holds that money and he is checking the boxes to say, are you making sure that you're staying within the tax code to make sure that your next purchase fits within that and that you're dotting your I's and crossing your T's? They're going to hold it. If you take your capital gains or your proceeds from the sale and you don't put them into a QI or an accommodator, this intermediary guy, then you can't go and do it after the fact. It has to be within that transaction. Okay. And he's going to hold on to it at least until for that 180 days. If you don't, you're going to identify, and let's say you can't find a property that can close, and this could happen to you. They fall out, someone else buys that one, and another one buys that one. And now you're left without something. So Nathan is going to hold on to that money until 180 days. You can't go in there and say, hey, can I take my money? Once he's holding on to that, he needs to hold on to it for the entire time. Is that correct, Nathan?
Great, excellent points. So the first one that you brought up was be looking for replacement before you even sell, right? Because we can send money to that replacement property on day one, right? I'm not restricted by where I can send money. If you're identifying and you're telling me send it here, we can send it here. We can get you closed out right away. If you're getting to a point where, hey, I am coming up on day 45, right? That's the first window of opportunity. So what we can do on day 45 is say, if you're not sure you actually want to go forward with something and you'd rather pay your capital gains, then let us know now. You essentially don't identify anything, and then we can fail your exchange on day 45, send you funds back. If you send me a letter of designation, identify, and say, I'm going to buy this, this, or this, I have to hold you to that by the IRS protocols. So if you're saying, I'm going to buy this, and I'm going to buy this, or this, okay, that's fine. We can give you the extension. We can give you the remaining 180 days at that point. But if you then tell me, actually, I don't want to buy any of them, give me my money back, I'm like, you sent me a letter of designation. These are the rules that I have to abide by now, right? I'm just an intermediary. So if I start showing that things look different, and I'm showing that I'm not an uninterested third party, that falls back on me, right? So it's a very simple thing that we do, but we do kind of report to the IRS and what we do. Otherwise, our business isn't legit anymore. So those are some very important things to know. But there's nothing keeping you from going into that property in a few weeks' time if you've already got it lined up and you're ready to go.
I always say, and I think my accommodators have been very good to kind of direct me, that you take on two deals. Like you've got three, take on two properties that you think you're going to be able to acquire. And if you can't acquire, what is that third one? What is the possibility that those two fall out? What can we for sure get involved in? And that could be a REIT, right? There's other, maybe Nathan, you can talk a little bit about that.
Yeah, I think it's actually might be my next slide.
Okay.
Or coming up. But yes, there are essentially backup options, right? With that. So it's, again, to Julie's point, talking to me before you even sell, right? Having a plan in place and then maybe leaving that third slot on your identification open to, well, what's available that I can for sure defer. If you need deferral, you don't want to take chances, right? You want to find everything that you can beforehand and be as sure as possible, but nothing's guaranteed on those contracts, right? Contracts fall out all the time. We know that, right? That's not something that we can help with. It's just the nature of the business. But there are Delaware statutory trusts. There are those parachute options that we talked about. So if things are falling apart and maybe you need to fail an exchange and go into a parachute option, or just say, hey, give me 2 years of parking into something, there's options out there, right? You can park your exchange funds for a couple of years and then try again. This is a long timeline kind of thought process that you need to have when it comes to deferring taxes, especially over the long term, right? I'm going to jump into the partnerships because this is where stuff gets interesting, and we can talk about drop and swap, swap and drop. But most of you know, hey, we're doing partnerships. That probably means we're doing an LLC. We can have so many members. Maybe it gets larger. We're having syndications with GPs and LPs. It's still a multi-tiered LLC, right? That LLC is its own taxpayer, right? So we can actually take entire partnerships and exchange them, right? Because that's a taxpayer ID. We can take individuals and do it. But if you're trying to exchange into an LLC, that doesn't actually work, right? That is considered personal property. It's considered interest in an LLC, right? Which is personal property, not real property. So that's why it doesn't work. It also doesn't work because that LLC has a taxpayer ID, right? And they're the ones reporting taxes. You're just going in and receiving a K1, which is not the same thing, right? We're tied to taxpayers and we're tied real property to real property. So that's why, oh, well, let me just get my shares of my LLC. I'll do this way. That doesn't work, right? So how do we get creative? That's what we're talking about here. But the exception that I talked about, and this is a weird one, right? So I worked in the DST world, Delaware Statutory Trust. It is still considered a 506B or C syndication. It has a trustee, right? Kind of like the GP in charge. They make the final decisions, but it allows up to 500 individuals to be considered separate taxpayers, right? And it is considered a security. I think the IRS and the SEC probably had a little backroom chat and said, hey, why don't you make this a safe harbor and allow this? That way we can, get some funds. But I digress. I don't know. For whatever reason, it is the one thing that you are not actually signing a real estate contract for. You are signing a PPM. You are usually going through a registered representative. But a DST is very restrictive, right? No capital calls, right? They must outline all of their budget expenses up front, which is why most Delaware statutory trusts, there are some multifamily ones out there, but you can't really do the value add. It's like new build. All right, let's dump it into a DST and hold it for 5 years. Or they're mostly triple net lease properties with, 10 years of lease term so that they don't really have to do anything. It's just kind of a cold place to store your money, in my opinion. But they are out there. They are one of the most common backup options for people who are exchanging and need something to identify, or they're retiring. They just want steady income. That's something that DSTs provide, but they are generally inflexible. You're not going to see probably any appreciation out of them, maybe a little bit.
Yeah, I mean, typically,
personal opinion, not financial advice.
Well, no, and I would say if I was looking at a DST, we would be looking at, in the past, it would be like 5% versus getting a 10 or 12, 14% cash on cash return. It's that much difference, yes. But it does secure you from having to pay your capital gains tax. Okay, continue.
Exactly. So tenants in common, people have heard about. It's a very old title structure. And essentially what it does is allow property to be divided up on the title level between individual taxpayers. It's a bit of the Wild West. There's not a whole lot of rulings and law on it. But if you're going to do tenants in common, I mean, you could do this on a single family, right? Investment. So Julie and I buy a single family rental for whatever reason. We could be 25, 75% partners. We could be 50-50, right? It's just a matter of what percentage of the property am I buying, but I'm not buying like this room and that room. It's undivided property as a whole, but I'm a 25% owner and Julie's 75% or whatever that is. That's what tenants in common allows you to do. The biggest thing that people run into here is that you're only limited to 35 people as tenants in common, right? And even if that was a partnership LLC that was exchanging and going into a tenants in common structure, that's not one taxpayer. That's still be considered two tenants in common going into that. And we have to record our taxes separately as profit and loss statements, right? So I'm not getting a K1. I'm not getting any of these other partnership benefits. It's a very raw, title structure. But the IRS has said, hey, these are safe harbor, even alongside syndication, so long as you have a TIC management agreement in place. So the IRS has said, hey, this is not truly the Wild West, so long as you have a TIC management agreement in place. We're going to consider it a safe harbor because the TIC management agreement essentially outlines, hey, this is, passive investment. It's a percentage of real property. You're not taking advantage of any partnership benefits that you'd have in an LLC, perhaps. You're considered separate tax-paying individuals or entities. So it is allowable. And this is tenants in common structures, something that we in the accommodation business use for kind of fancier ways of even dropping people in and out of LLCs, which I am covering now. Right?
Okay, I want to stop there for just a minute. So guys, again, I've done this. I went from single family into a syndication. Okay, so I parked the money with Nathan. He got me all lined up. We close on a syndication. But before that, I have to have my attorney write up the TIC tenants in common documentation. And as Nathan said, I'm going to be on the same level as the general partners because we are partners, tenants in common together, but I don't have general partnership shares. I actually have limited partner shares. I don't have a voice, although I do have a voice with the lender. I have to vote. I have a quote unquote voting right, but it's, you really are a limited partner, even though in a syndication, if you're on the same level, you're a general partner, yes, in the eyes of the lender, but in the syndication, I am a limited partner, general partner to limited partner. So be very careful. You don't get to go into this and say, I am in charge. You are, the TIC kind of hits you in the head and says, sit down. You don't get to run this. Keep going.
Yeah, no, excellent point. It's same, but different, right? Like you don't technically have an LP designation because you are signing on the debt, but you have to act as one in terms of your passivity. And your TIC management agreement is essentially assigning over the management to the GP team, which is what you want. You want them to do all the operations, right? But you do have this voting right thing, which they can override if worse gets to worse. So that's how the IRS is allowed it to be safe harbor. But there's tenants in common, like I said, bit of the Wild West, but there's some rulings in place that have helped made this feasible for tax deferral, which is great. How we've often used these in the past is, we may have heard of drop and swap or swap and drop. Essentially, you can, like Julie did, go into a syndication as a tenant in common. So you're doing your swap, you're doing your 1031 exchange, and then down the road, because you're doing two separate taxes. Hey, Julie's getting a profit and loss statement on her X% of the property over here, and the GP's getting that over here and dividing that amongst all the members, of the syndication. That can be a lot of accounting, but after a period of time, they can say, hey, why don't we just absorb Julie into our LLC, right, into our syndication, and we can give her that allotted amount of her percentage as shares, and that's totally possible. It needs to happen after a period of time. The IRS wants all things to happen after a period of time. How long that period of time is not up to me. That is up to your CPA and your legal counsel. But just know that it is possible. We do the same thing in reverse. If you're in an LLC and you're wanting to go separate directions, some of you want your cash. You don't want to do a 1031 exchange. The rest of you do. You would do what's called a drop and swap. So you drop from the LLC level. You would basically take, hey, what is my percentage of the LLC, and I'm going to take that in title shares, and that allows me to be a separate taxpayer. Again, you probably want to hold it this way for a period of time if you're going to 1031, right? But that allows you to 1031 exchange on an individual level, and you can all go your separate directions. Or some of you may want to stay partnered. That's fine. But that's the difference between a swap and drop and a drop and swap. We utilize tenant and common structures in order to pull that off, in order to pull off individual exchanges that way. And I think I have an example here. Yeah. So imagine, you had a fourplex with, you and partners had it for 5 years. It had 4 members. Everybody essentially owned, simple math here, 25% of the LLC. 2 of the members, they want their cash out, but 2 of them want to do a 1031 exchange. They want to continue together. This is easy because I don't need to hold that property for a period of time separately. The LLC is still taxed at a partnership level. If 2 people stay in, it remains a partnership, not an individual. So those 2 stay in the LLC. They just retain 50% of the property. But, Bob and Sue wanted their money, so they took 25% of the property. Everyone's tenants in common. There's 3 tenants in common here, right? And so 1031 Way LLC is able to 1031 exchange and move to another property, and continue on while Bob and Sue, they just collect their cash at closing. So that's a very simple one, but that's an example of how you can do a drop and swap. If all 4 members were looking to go separate ways on a 1031 exchange, some of them receiving cash, some of them exchanging but not wanting to stay together anymore, you'd probably want to do that before closing, or even have a tax season or 2 on record, to keep in compliance with the IRS. But in this case, the LLC had the property for many years and it stayed intact. So that
okay, let me just make sure I understand this. So in these syndications, you've got a great operator and everybody wants to go to the next one. This operator did an amazing job. I'm making 170% return. I'm going to think that he's going to do it again. Not everybody has to go into the next property. That's what you're saying. Is that right, Nathan?
That is correct.
I was under the understanding that everybody had to go, otherwise it broke up. We couldn't go into the next syndication altogether as a 1031.
So there's a couple ways to do it as well. I have another example at the end of the presentation. But yeah, if some people wanted to just receive their funds back into their, retirement account that's already tax advantaged, they can do that. So you can drop them off, and then everybody who wants to stay, who had equity invested, they can stay in the LLC, and the LLC just transfers on.
Excellent. Great point.
Yeah. So something to consider. Now we're getting into real meat and potatoes. If you are a sponsor, right, and you have a property, know that the person doing the exchange, the exchanger, they have the 45-day designation, but this is what they have to designate in terms of a undivided interest as a tenant in common, right? It'll look something like 11.882% undivided interest in whatever the property address is, right? And so that percentage is very important when calculating actually how much of the property they own, how much the syndication retains. And, the cool thing about this is if you have the property under contract, you can just assign them a percentage of the contract, right? Because that's being done in real time during escrow. So, and then title gets recorded as tenants in common. So, they just need to be aware, both the exchanger, hey, what did I sell for? How much is my equity? How much is my debt? The sponsor needs to know about that. And then they need to say, hey, this is how much I can give you of this deal based on your equity. Let's make sure it's covering the debt. But all of that needs to be calculated probably before the sponsor closes on the property, because that exchanger's deadline is probably going to come up before you close. Maybe not, if things are moving quickly, but or if they just closed and just entered into their exchange and you're closing a week later. But you guys know how long these attorneys take putting these things together, signing a contract, tick management agreement, all that stuff. That's more paperwork. That's more time, right? So a lot of these things are going to take weeks maybe to actually structure correctly. So having those conversations knowing identification, what it's going to look like percentage wise, is going to be very important for both the exchanger and the sponsor.
So as a sponsor, just jumping in here, as a sponsor, all of us who want to be sponsors, okay, become the best resource of a 1031. But you have to know that it's going to cost you to bring in 1031 money. It can be as much as $10,000 per person. So you got to make sure you're putting that in your budget. There are some syndicators that say I have to have a minimum of $1 million because of the cost associated. Now, some of the syndicators will say it's the person who's bringing in the tick that's going to pay for those costs. But sometimes this sponsor is so happy to have a large chunk of money that they're willing to put that money to use and pay for the attorney and the all of the structuring of the tick.
Exactly. And if you get one in, usually it's easier to add 2 or 3 more tenant in common exchangers in as well. Right. But yes, it is just most sponsors that work with me and I'm putting exchangers into their deals. They're like, it's got to be minimum of $1 million, maybe 500,000. Nobody's out there doing 100,000 at a time. I have exchangers coming to me. I want to invest in a syndication with an exchange. And I'm like, if you know somebody that'll take 100, great. But yeah, I don't know any that do. Right.
Great point.
So just know that, yes, costs are real. Time is real. But there are ways to maybe mitigate that. The calculation that you're actually doing between sponsor and exchanger, I just ran a quick example, again, trying to keep the math simple for everybody. Exchanger sells property for $1 million, right? They had 50,000 in closing costs, so that actually reduces their relinquished value, right? Those are valid expenses for 1031 purposes, which means that their relinquished value is $950. Cool. They paid off a $500,000 mortgage, right? Which means that they have $450 in net proceeds to put into a deal. Do you want that or not? Maybe, right? But they will need $950,000 in replacement value. Otherwise, if they don't get that replacement value, there'll be a tax liability for the exchanger. So if you're a sponsor, you have a multifamily deal under contract, let's call it $10 million, 60% LTV loan. That will come in if you're calculating replacement value for them and how much they need to put in to cover their value. But let's say, hey, I'll offer you 9% of the deal as a tenant in common. The syndication takes the other 91% for your 450 in equity. The calculation for the exchanger takes place on that contractual level, right? So if that, you would just take, hey, 9% of $10 million of the purchase price is actually $900,000 in value, in replacement value. So what does that mean? They're missing $50,000 in replacement value. They're going to have a tax liability on $50,000. Maybe they want to do that, maybe not, right? But just know that. Now, maybe you bump them up to 9.5 or 10% of the deal. Hey, that would actually equal, $950 or even, $500,000 in replacement value for that deal. So that should be fine.
That is insane. That was deep and really complicated, but that is what you need to figure out if you are a 1031 exchanger, because the whole purpose of this tax code is to protect you. So if you are going into syndication, you're not getting the right exchange. I don't know if that's the right word.
Value, replacement
the right value. You're not really doing yourself a justice. So again, you need to talk to Nathan and say, okay, this is what I need to get, how much of the value I need. He can give you that information, and then you can go out and find opportunities where these syndicators can help you stay in compliance.
Exactly. Yeah. So that's a very simple example. I give it and that's not something your accommodator would normally do. That's what I do just because I've cut my teeth in multifamily in Los Angeles. Like, I've put together a lot of these tick structures for people, just trying to help them. Hey, well, are you actually getting the value for your exchange? Because you know about it and I know about it, but does your sponsor know about it? And they're just saying, oh, well, we'll do this. And it's like, does that actually match up for you? So just doing those calculations for them, because I've been in the business, is not something most qualified intermediaries do. I don't know any other qualified. I'm the only dumb one, I guess, who likes to help people. So that's what I do, but that's just something as a sponsor, as an exchanger, you should be aware of. All right. The other one, this is up Julie's alley. She knows this. You also sign on the debt. You have to. That's part of the TIC management agreement. If you're relinquishing debt, you signed on that loan. You don't get a pass as an LP, as a tenant in common, and not sign on the debt. The IRS says if there's a blanket loan on the property, tenants in common must sign on it. For many of you, that may be a benefit because you want your Fannie Freddie stamp, right? And it's a Fannie Freddie loan. Awesome, right? That may be a step up, getting into that GP stage for some people. But it is required, right? It doesn't go away. So, maybe even bringing someone in as exchanger gets you a key partner for signing on the debt as well. But just know that is there. That will need to happen, right? In a tenant in common structure, even with a syndication. And I mentioned earlier, they can bring cash to cover replacement value. So you might even say, hey, previous example, we're only taking like a, $500K minimum, but if they bring in, an additional $50K to add to the pool, right? They can wire that in separately from their own funds, and that can help with their replacement value as well, right? They may still be signing on the debt, but they can always inject cash into a 1031 on the backside, right, in order to make this possible for them. Or maybe they just rather have the liability, because $50K in capital gains is basically what they'd pay if they didn't get that replacement value covered. And maybe they were looking at, 200,000 in capital gains or more, right? So 50K is not that bad. So those are things to consider with their CPA. This one is more for sponsors, and it's like doing a drop and swap. So you can do a partnership installment note. So you can essentially go to this gets complicated. You will need an attorney to draft this for you. But let's say the majority of the syndication wanted to exchange, but you did have some people who invested in tax deferred or advantaged accounts, and they just needed the return. They just needed the cash to go back into their account. So you can essentially say, well, how much of the capital needs to be allocated to those tax advantaged investors already, while the rest of us take advantage of a 1031 exchange, essentially create a note for that equity that would go back to those investors. You complete the exchange as the ones with the equity, not looking for a partnership installment note. After you close the QI, because the QI has to hold the note as well, they can give the note back to the taxpayer, which is really just funneling that back to the 401k or the IRA investors into their tax advantage account. So you can do essentially a partial exchange, but it's for the people that need it, and it's still a full exchange for them. And then the boot, which is taxable, just goes back to the people who are already in tax advantage accounts. Highly structured and nuanced, but just know that is out there as well. So if it's a larger syndication and this is really, an issue for you, not everybody wants to do a 1031. Only some people do. We can do a drop and swap. We can do a partnership installment note. These things are possible, right? And always be aware of depreciation recapture. I know it's fun to save on your taxes up front, right? But just realize they come back in the end, right? The 1031 also defers depreciation recapture. So, keep that deferral train rolling. Just realize that it's there. Okay. So if you didn't bring any exchangers in on the front end, but everybody's looking to do, taking advantage of cost segregation on the front end, they may want to take advantage of a 1031 exchange on the back end. You just need to be aware of that, plan accordingly, right? If you want copies of the slides, if you have questions, there's my information. Go ahead and email me if you want the slides. If
How
your
about this?
questions are super nuanced, you can call or text me.
How about this? Could you give us the slides and we will send it off with our video that we do every Friday? All right, so you guys will look for that attachment in Friday's video that we send out, the YouTube video. So that's awesome. All right,
Thank you.
this is amazing. This is probably an area that none of you knew about, or that you didn't have the resource to figure it out. So you now have a resource. Nathan Webb with American Accommodators. We've given you the contact information. Again, you don't have to have all of the answers for when you are thinking about going out and saying. You could even post this if you're doing a 506c. Go onto the internet and say, hey, I'm looking for 1031 exchange investors. Then you could then say, hey, great, I'm excited, I really welcome you, we're looking for 500,000 to $1 million. You need to speak with my buddy Nathan. He will set you up. Because a lot of people don't have an accommodator. They don't know what they do. So Nathan is going to be a great resource. And I would jump on a call before you put this out, because 1031s, again, it's bam, you get a bunch of money. But here's the drawback. You might be thinking, hey, I'm going to get this. I'm going to get this guy his money. He might not have closed by the time you need your capital. So you got to be really careful of taking their money. And then also, if you're the person who has the money, you got to make sure that it's available when these guys are closing. Again, all of this is preparation, upfront conversation. Educate yourself, educate your investors. This is a great solution. Now, I want to go one question for you, and I don't want to go really deep into it, but there is this thing called a reverse 1031 exchange. And what that says is you've identified a property. I want to buy that. This property has not sold yet, but I want that one, and I don't want anybody to take it. So the reverse would be you would make sure that Nathan can find somebody that's going to be able to help you put a loan on it. I wouldn't be doing that. Let's say it's a single family, but Nathan, can you kind of walk us through that real quick so that maybe that's an option? Not necessarily on a syndication, but maybe on a single family or some other type. How would that look?
Yeah. So the reverse exchange gets a little complicated because essentially you are purchasing a property before you sell, but you have 180 days to sell once you purchase that property. And there's even some possible extensions to that, like a bartel exchange, right? Don't want to get too complicated, but the biggest hurdle is if you have the cash to actually buy that property first, you're essentially lending the accommodator the money at 0%. They're purchasing on your behalf. All we're doing is holding title for you. You manage it. It's your LLC. It's triple net basis to you, right? You can take the income. You can do all those things. We just hold title, and you have 180 days to sell. And as soon as you sell your relinquished property, we just swap out the title, but you have 180 days to do it, right? You can do that on an exchange safe harbor level. You can do that on a contractual level. So I always tell people, especially if you're working with like smaller properties, you're with investors, always write a contract on something you want to buy. Do your due diligence. You can put your earnest money in, and then, but you know that you have something that you're going to sell. You pretty much know what it's going to sell for. Maybe it's already under contract, but you're just waiting. Start making offers right away, because you don't need your money with the intermediary, with the accommodator, until it actually needs to be sent. You can write a contract, put some extensions in there, right? I'll do, give me a 60-day extension for additional earnest money, for additional hard deposit. I've already done my due diligence, want the property, because when your exchange funds come in, those exchange funds fund out your earnest money. So your earnest money is hard, but it's going towards the purchase anyway. So when your exchange funds come in, you get your earnest money back. That's tax free. You put your own money in. It was tax, pre-tax, post-tax. Nobody knows, but you're getting it back because the timeline for your 1031 exchange, the line item just shows your exchange funds going to the purchase of this other property, and you're getting your refund. So you can think about doing a reverse on a contractual basis, which is still just a forward 1031 exchange for our purposes, but it's still just finding the property you want to find first, And if, let's say, for example, you did have that contract, you already did your extensions, you really want the property. Oh man, but my property didn't sell for whatever reason. Well, guess what? Now we can actually put a reverse in place, right? You can get a lender to lend you the money, until you have 180 days to sell, right? And then your proceeds come in. So it kind of looks like tier structured lending. Sometimes it can get complicated, but the reverse is another backup if you're proactive in finding the right property. Those things are possible.
Excellent. Awesome. All right. Alan Majors has a question. Third party bought a bad deal just to make a 1031 happen. What do they need to be aware of if they sell less than a year later? Anything?
If they sell less than a year later, they, I mean, if their CPA says they can 1031 again, I've had people do it. Typically, their CPA will say, no, it's short-term capital gains, or they're taking losses, right, in order to sell the deal. So you still, basically your basis and your gains traveled with you. So even if you're selling at a loss, was it a complete loss or a partial loss, you may still owe capital gains if they're selling. If they want to try to defer again, at least put a tax season on the property, see if you can do a 1031 again and find a better deal. But again, that's why you try to find your deals ahead of time.
Gotcha. All right. If you found a client is in the middle of a 1031, what is the most important questions we need to ask that client?
If I put myself in like a sponsor's shoes, okay, you're in a 1031, you're looking for a replacement property. What did you sell for? Right? How much equity do you have? How much proceeds do you have? You can do a lot of math that way. But it comes down to what their tax status is. Right?
Okay.
So like that, hey, we sold for $1 million. I got 450,000 in proceeds. Right? We can figure out a lot of math that way. But I would start with that. And then it would be like, hey, well, how many days until you identify? Well, I'm on day 50. Well, they've already identified.
Yeah, that's great information. All right. The person that writes up these TIC agreements, Paula, is your attorney. And we've had attorneys on. Dugan Kelly has been here in the past. I've been trying to get him back. We will have an attorney to kind of underwrite how this works, the TIC and the structure of that. He just hasn't been available to join us. I was trying to do it back to back, so look for that. We'll be doing that soon. All right. I think that's about all the questions I had. Anybody have a question in the house before we say goodnight to Nathan?
I do.
I love it, Alex. I can always count on you.
Hi, Nathan. Two questions. If you selling on a loan on a owner finance, so you taking a note, can you do 1031 exchange?
So for example, Alex, you're selling a property and you're offering owner financing to the buyer.
Correct.
Yep. You can do that, and you can exchange the note.
Okay.
So you would assign the note because that's part of your equity, right? So that's part of your value.
Yeah.
When you're selling, if I'm selling for $1 million and I'm offering to carry back 250,000, my sales price is still $1 million, not my value essentially. So if I want my equity, some other lender came in for 750, right? But I carried back 250. I can take the cash, send it to the accommodator. I can also assign the note to the accommodator as well. Payments have to go to the accommodator, not directly, but to your exchange account.
Okay.
We're just holding all of that for you. We're just the intermediary. But then we can assign that note to a replacement property. So if you found a property and the seller of that was like, hey, well, I'll take your $250,000 note and your proceeds for my property, right? Cool. They can do that. That may be tax advantage for them. You could also potentially buy out your own note with cash, right?
Okay.
If you had some cash, and then that way you're sending all of the proceeds to a replacement property. Now you've got a note that's cash flowing you, and it's not even an installment sale. You're only paying on the interest because you bought your note out with cash. You could also have a third party buy out your note. But yes, you can 1031 exchange it. You could also accept the note, pay an installment sale on that, and then you just would need to find like $750,000 in replacement value.
That's
Okay.
insane. What's the other
It's
question, Alex?
insane world.
So the other question is, if I live in a property as my primary residence and I also rent a unit, can I do partial 1031 exchange?
You can do a 121 exemption and a 1031 exchange. Duplex, right? Live in one
Yeah.
side, rent out the other.
Yeah.
Half of that works for a 1031. The other half you can get, the 121 exclusion, which is up to 250,000 in capital gains excluded, forgiven filing individually, or 500,000 filing jointly. Do that all the time,
Awesome.
especially in California.
Awesome. Thank you.
Great question. Man, you always
Excellent
come up with them,
questions.
Alex. All right, who else before we say goodnight? Anybody? Evan? Sandy? Sanjay? You guys good? Paula? Don? All right. Speak
If
now
you
as
have
my
any weird ones that come up a week later, just give me a call or send me an email. I spend most of my days answering questions.
Well, this has been fantastic. Once again, always appreciate you coming on. And, we've got like the next phase of investors. They go off, they get new ones. So it's always great to educate them on what possibilities there are to getting capital. Today is very difficult to get capital. So the 1031 exchange, is it going away?
It's been under threat for a long time. I think if it does go away, it won't be directly. It'll be indirectly. It'll be by capping capital gains forgiveness or deferral for individual taxpayers, which is more tragic. So be on the lookout for that. But yeah, we'll see.
Awesome. Can you make sure you put your chat information in the chat? Everybody's going to take that. That would be great. Oh, Kevin, what do we got?
Okay, I have a question on I know that eventually you have to pay those taxes. How many times can you flip it over? No?
No, keep going. Yes, you can keep going.
Oh, okay. So when do you actually pay it then?
Nathan?
Never, if you do it right.
Correct. Your
So
kids,
here's
you
a
die,
couple interesting strategies for you. Ready to get your mind blown? Living trust. If you have kids you want to give your money to, living trust, they'll take a step up in basis when you pass away. So that means all your assets pass to them. They can sell them right away, pay no capital gains, no depreciation, recapture, if you want to give it to your kids. You don't want to give it to your kids, exchange into a zero refi deal. So you put all your equity into a zero refi where it's zero cash flow, but they will refi you out sometimes up to 85%. Refis are tax-free. So you can take that money, reinvest it, go buy your Porsche, go buy whatever you're going to do. You just got to leave 15% of your capital in that case into a deal in order to get the rest of it out, right? Which is less than capital gains. So you can think of it like, hey, I'm going to, go into this and I'm going to have to leave some capital intact for maybe it's a 20-year zero, but you can pull up to 85% of that out tax-free, spend it on whatever you want. Reinvest at a new basis if you want to.
Amazing. All right.
Thank you.
Make sure you guys get a hold of Nathan with any further questions. He is a great resource and so helpful to answer your questions in a very timely manner. So again, thank you so much, Nathan. You're awesome.
Julie, love you. Thank you so much for having me. Thank you so much for hosting this. Appreciate it deeply. Thank you.
Absolutely.